Last time, we learned some key terms and concepts such as acquisitions, mergers, the horizontal integration, or the vertical integration, or the diversification. And today, we are going to talk about the reason, the fundamental reason why the mergers and acquisitions exist in the reality. So, as usual, let me start from the idealistical world without any conflicts, and then we are going to make it more realistic by adding some assumptions. So, let's say there are two firms, two companies, firm A and firm B. And currently, the value of the company A is 100 million. And it has, among the 100 million, it has 30 million cash, and the rest of it is invested in some fixed asset. On the other hand, the value of firm B is 20. So firm A is larger and firm B is smaller, considering the fact that usually a larger company acquires a smaller company. And however, even after the acquisition, still the value of the company does not change. So it will be 20 million after the completion of the mergers, $20 million. So that there's no change in the value of the company. And then let's check whether the firm A can acquire firm B or not. So case 1. So this is totally about how much firm A gives to firm B's shareholders, because shareholders, in return, shareholders will give their shares to the firm A, and by doing so, the firm A can control firm B and they can start the merger activities. So, as a beginning, firm A may say, we want to acquire your company by giving $10 million. And then, definitely, it is not possible because the shareholders of firm B know that their company's value is $20 million. So they have already 20. However, what they are saying, what the shareholders of A or what the firm A says is that they are only going to give 10, which is about half of the fair value. So shareholders of firm B would decline this offer. So there is no reason for the firm B shareholders to accept this acquisition. So this is simply not possible. And second, then maybe firm A can raise their offer. So they are going to say, we are going to give you $30 million. In return, please hand it over your shares. And firm B's shareholders will be very, very, very happy because what they have is 20, but in return, by giving it to firm A, they are going to get 30. So this is a profitable investment decision. So they are going to accept this offer. However, for the shareholders of firm A, this is actually a disaster because they had 100, but now they are going to give 30 to the shareholders of firm B, and in return, what they get is only the firm B, which has only a worth of $20 million. So in total, what they have is 100 minus 30 plus 20, so they have 90, which is even worse than before. So from the perspective of the shareholders of firm A, there is no reason to offer such high compensation for the firm B's shareholders. So again, they are not going to make it from the beginning, so it's not possible. Then then now we have two conditions. So when they offer a lower value, it is rejected by firm B, and when they offer higher value, it is not possible because the acquirer would not make such a deal. So maybe the only way to make it possible is to give the fair value. So maybe they are going to say, let's trade your company with $20 million cash. And let's see. And then what they have, the firm B's shareholders have 20, which is actually exactly the same as before. And at the same time, for the shareholders of firm A, what they have is they had 100, but they pay 20, and in return they get 20. So again, they go back to 100. Then they are going to ask themselves, why did we did these such activities knowing that there is nothing have happened? So they are going to say it was just a waste of time, and it was just a waste of my effort, and nothing actually helped me out from getting higher values from this transaction. So this transaction is possible technically, however, but there is no reason to do so because nothing have improved from the before. So this example shows that in a perfectly clear world, when you can see the value of the companies crystal clear, then acquisitions and mergers, they are not possible because actually you know the value of the company and the transaction does not make any difference. Then why in reality, why can we see some mergers and acquisitions? This is because something changes. So let's modify the assumption slightly. So the value of the company is still 100 million. The value of the company B is still 20 million today. However, for some reason, after the acquisition, let's say the company B's value can be 40. So there is an increase when the firm B is controlled by firm A. And then let's repeat what we have done so far. So again, when the firm A says we are going to offer 10 million, firm B will decline because they are not getting what they deserve. Second, and let's look at this situation. So firm A pays 20 million to acquire firm B. Then something has changed for firm A's shareholders. So they had 100, but they are going to pay 20 to the shareholders of firm B. And in return, what they have is firm B, but the value of the firm B is now not 20, it's now 40 because now it is in the hand of firm A. So the value of the combined firm increases to 120. So for the shareholders of firm A, there is certainly some reasons to seek out this merger opportunity. However, the problem is still for shareholders for the firm B does not get nothing. So they are going to say, what I get? There is nothing that I get from this merger and acquisition, so therefore I don't want to help you out. I'm just going to control my company, and maybe you are going to suffer, but that's not my business. So in this way, when the firm A tries to acquire the company B at the fair value, it is still not possible. It is very difficult to convince firm B's shareholders to agree on that matter. Then the only way is that they are going to offer 30 million, which is exceeding the current value of firm B. Then shareholders of firm B would be satisfied, so they are getting 30 despite the fact that they only had 20 before. And at the same time, shareholders of firm A, they are overpaying it, so they are paying higher prices, but they have something because they had paid $30 million to firm B's shareholders, but in return, still they get the firm B, which may have the value of 40, not 20. So therefore, in sum, what they have in the hand of them is that 110, which is better than the previous situation. So therefore, we can have a win-win situation. For shareholders of firm A is happy because now they have firm B, which is improved. And firm B is happy because when they had their firm company, they had only 20, but they are compensated by higher prices. So both of them are happy, and therefore this transaction is now possible. So see, from this example, we can understand the fundamental reason why mergers and acquisitions exist. So the only difference from the previous example and this example is that now the company's value changes after the mergers and acquisitions. So before the acquisition, the company's solo value when they are independent is 100, and the company's B's single value is 20. So in sum, they have 120. So they have 120 together. But after the merger, now the company B value changes. So actually, the combined firm has the value of 140, which is higher than compared to the situation when these two firms are independently managed. So this positive factor, this positive difference is called as synergy. Sometimes when you have this one, when you have that one, and when you run these ones separately, nothing happens actually. However, if you run this together, if you put these things together, and if you run together, then there is a synergy. So you have some increasement in the value. So this is called as the synergy. Sometimes companies can have better values compared to the situation when these companies were independently, separately managed. And at the same time, you should also understand that the synergy is not only for the shareholders of the acquiring company. So we see that the firm A, the shareholders of firm A get something, and at the same time, they are not only the winner. At the same time, the firm B's shareholders obtain something from these transactions. So what they have is that it's coming from the overpayment. So the acquiring company pays much more higher prices compared to the actual value of the company B. So this is called as the acquisition premium. So during the acquisition, we often see that the acquiring company pays higher prices to the target company. And through this process, some of the synergies belong to the shareholders of the target company as well. So we have a win-win situation. So both shareholders better off. They have earned something from this acquisition. Not this is not only for the acquiring company's shareholders. So this is very important point. So especially in Korea, sometimes we often misunderstand the mergers and acquisitions. So when you read the newspapers, sometimes the tones, the arguments of the newspapers say the news reporters or the public or maybe politicians, they misunderstand the fundamentals of the mergers and acquisitions, and they say that M&As are bad. However, this is not true. In the M&A process, shareholders get the synergy, and the shareholders are not only the acquiring company's shareholders. Still, at the same time, on one hand, we see that the shareholders of the acquiring companies get something, and at the same time, the shareholders of the target company also have some benefits from the mergers and acquisitions. So therefore, we should be very happy whenever we see there is the mergers and acquisitions. Sometimes, especially sometimes I see that Korean publics are so full with they are with some kind of nationalism. So whenever they see that some companies, the ownership of some companies are transferred from the domestic investors to the foreign investors, they are crazy. But this negative adverse reaction does not help the situation in Korea. Actually, it is better to be globalized because when it means that the acquisition from the foreign investor, it means that foreigners are investing in our company, in our country. So it is actually better for our economy. However, if you just try to understand it from the nationalistic point of view, then you don't fully understand what is happening right now. So you should try to have a more balanced point of view regarding the mergers and acquisitions. So during the M&As, the stock prices usually skyrocket, it goes up, and therefore shareholders can make more wealth, so they can be better off. And considering the fact that the ultimate goal of the management is to help the shareholders, and M&As is one of the way to improve the shareholders' wealth. It helps the shareholders, so therefore we should try to facilitate the mergers and acquisitions. So this is a contrasting view from the academia, which is based on the facts and statistics, and the point of view from the public, which is somewhat more emotional and sensitive. So I'm sorry that sometimes some newspapers argue that whenever we have some mergers and acquisitions, we are losing this company to foreigners, but that's not true. Anyway, let me come back to here. So the reason behind the merger and acquisition is because there is synergy, or at least someone is believing that there is synergy. Then where can we obtain the synergy? So there are two major sources. So remember that the value of the company is generated from the cash flow from the future, in the future. So whenever we have an increase in the cash flow, we have a higher value. Therefore, the synergy should also comes from the enhanced cash flow. And the final cash flow we get, it is coming either the increased sales or the reduced cost. So we have two ways to have synergies. First, we may have higher revenues after the M&A, or we may be able to reduce our cost. So these are the only ways to have the synergies in actually. Then how can we have the revenue enhancement? We can increase our revenue after the merger. First, through market dominance. This is particularly true for the horizontal integration. So you conduct M&A with your rival. So before the M&A, your market share was only 20 or 30, but after the merger, now you have a market share of 70 or 80. Then you can actually make a choice to increase the price of your product or the services. So therefore, you can earn much more from the sales of your products and the services. Second, maybe you can try to bundle your products into a say some kind of group. So the bundling means that you are not going to sell your products independently, but you are going to combine it into a group so that the customers buy one thing and the other thing together. So one of the example is the Microsoft. So the Microsoft sells Windows, which is a operating system of your computer, and at the same time they try to have a bundling. So when you install the Windows as your operating system and it follows Internet Explorer, and usually the main page that you open it, whenever you open the Internet Explorer, you get into MSN, which is also the website run by the Microsoft. So this is a typical example of the bundling. So you don't have to look out for other internet browsers. So before the Internet Explorer, we had different kinds of browsers such as Netscape and Firefox. However, they are disappeared because they were not competed to the Internet Explorer, because most of the users use the Internet Explorer, which is automatically installed into your computer. So bundling has a strong power to collect and to boost your customers. So this is the reasons why the M&A can increase your revenues. And secondly, this is more important, we can reduce cost substantially. The first reason is that usually in industries, in most of the industries, there is so-called economy of scale. So the economy of scale is this one. So the typical industry is the telecommunication industry. So the telecommunication industry in Korea, we have three competitors, which are SKT, SK Telecom, which is famous for its esports game players T1, and also we have KT, the Korean Telecom, and LG U+. So these three major players are competing each other, and the reason that we have three different telecommunicators in this company, in this country, is that we want to have at least some kind of competition among them. However, because they are competing in this Korean peninsula, SKT has to make an investment to install their wire system around the peninsula, and at the same time KT also need to install their service centers around the peninsula. And finally, LG U Plus also need to make such huge investments in order to provide the 5G services to their customers. So from the point of view of our country, this is a duplicated investment. So we are actually spending 3 times money when we had a monopolistic player in our telecommunication industry. So therefore, there is an economy of scale. If these companies were merged into a single entity, they don't have to spend such huge money invested for their operations. So therefore, we can save some cost. So this is what the economy of scale means. And second, the technological advance. So the typical example of this technological advance is the Google. So originally, the Google was the provider of the internet searching engine. So they started their website google.com in early 2000, and at the time what they had is only the engine. So they provide some efficiency whenever some people try to find some useful information from the internet. And then after they were successful in their IPO, they had a huge amount of cash, and they started to spend this cash in M&A activities. So they purchased the YouTube. So the reason why they are doing this is to obtain the required technologies and human resources from the venture companies. So the Google had some kind of M&As about 100 times or 100 cases. So now it became a very large conglomerate that has some operations throughout all kinds of internet related services, but this was only possible through the mergers and acquisitions, and the main reason is to acquire new patents, new technologies, and new human resources and new inventors. And third, this is the most important reason from the point of view of finance. So the reason why we have synergy is because some managers are poor. So there is the conflict of interest. So we have the separation of ownership and control, or the ownership and the management. So what this means is that we have shareholders who own the company, and at the same time we have professional managers who control or who manage the company. So shareholders and managers are not the same people. And that is the separation of the ownership and the management. And this is for the convenience, because shareholders are busy with their lives, so they can join together. They cannot be together thinking about the future of the company, and at the same time they don't have enough skills or technology to analyze the complicated modern business. So therefore they rely on the management. However, although there is a significant benefit from the professional managers, the CEOs, at the same time we have some negative aspects, that these managers are also human beings who are selfish and who seek out their private benefits. So we see that when they have a business travel, they usually reserve the business level ticket, which is significantly expensive, more expensive to the economy seat, right? And they also spend huge money to decorate their offices. They also hire the drivers saying that we need to save our time. And they also buy some expensive cars using the money of the business. So they are taking some private benefits. So we can say it is okay that you can also achieve your personal benefits if you are doing best for the shareholders. But sometimes they are going beyond this and they actually harm the shareholders. Then what we can do as shareholders is that we can fire these managers. And one of the easiest way to replace the poor managers is to have M&As. And after the M&As, now the new major shareholder can say to the existing management team that you are fired. So please go out and you don't have to come tomorrow. And then they are going to hire the new CEO, the new CFO, and new COO. And these people are now hired, so they are going to do their best. So we can try to make some cuts which is transferred from the company to the management's pocket. So this is one of the reasons why M&As are helpful for the shareholders. So sometimes managers are evil, so we need to kick them out of the company. Okay. And so far we understood the terminology, we understood why there exist M&As. Then let's move on to the next section, which is about their deal or their negotiation. So the easiest way of making an M&A possible is to give cash to the shareholders of the target company. So as we see in the previous example, the acquiring companies pay the shareholders of the target company certain cash and the deal is completed. So this is the easiest form of the M&A. However, in reality, sometimes we have different aspect, which is the stock acquisition. So let me compare the two different kinds of the deal. So we have cash acquisition. So we have an acquiring company, acquiring firm. I'm going to say A for this. And we have a target company, which is T. T stands for the target. And in the cash transaction, the acquiring firm pays certain cash to the shareholders of the target. Then in return, the T's shares are transferred from the shareholders to the acquiring firm. So this is the typical cash acquisition. So this is very simple. After giving out the cash, now the shareholders of the target move on. So they are done and they are we don't need them anymore. So that's done. It is done for them. And now the acquiring firm's shareholders are going to manage not only A but also the T together. But sometimes maybe they don't have enough cash to give, then they may choose the stock acquisition. And in this situation, so we have A, the acquiring company, and we have the target company. And this is the same. We need the target shares. So we need to buy the stock of the target. But what we give is A's share. So we don't have cash. So we are giving our own company's share to the target company's shareholders. However, this is a point where students misunderstand. So these shares are new shares because the already existing shares are in the hand of the shareholders. So we cannot take it from our shareholders. Therefore, what the company can do is to issue new shares and give it to the target shareholders. And in return, they give out their own shares to the company. So the stock acquisition is actually the stock exchange between the shareholders of the target and the acquisition company. So sometimes there are benefits of having cash acquisitions. At the same time, there are some reasons why we should do some stock acquisitions in some cases. So the benefit of the cash acquisitions is that the acquirer gives cash, and that's the end for the target company's shareholders. So therefore, they have no interest in the merged company, and the acquiring company's shareholders can enjoy 100% ownership of the merged company. So in other words, there is no dilution. And this is also good for the target shareholders because they get fixed compensation. Cash is a robust compensation. So I get this and I don't have uncertainty, right? So they can move on. But sometimes for the acquirer with not enough cash, they may try to use this stock acquisition because they don't have enough cash. So the stock acquisitions can have some benefits when the acquirer do not have enough cash. And in return, what they have to suffer is that now they are going to give certain ownership to the target shareholders. So there is dilution. But maybe the target shareholders may want to do so. This is rare. However, sometimes the target shareholders also want to have the stock acquisitions because maybe after the stock acquisitions, they can also participate in the management of the merged company. So they have the shares, so they have ownership, so there is some interest for the merged company. So therefore, as the company grow in the future, they can enjoy more potential for the stock prices increases in the merged company. So cash acquisitions and stock acquisitions have their pros and the cons together. And then which one is better? The answer is in an idealistic setting, we don't see any difference. So as usual, let me start from the cash acquisition, and I'm going to compare the result with the stock acquisition. So let me give you some example. So there is firm A and B. So the A is the acquirer and B is the target. And A is going to pay $115. And firm A currently has 25 shares, and each share is worth at $20. So the A's value is 20 times 25. The stock price is 20 and there are 25 shares, so it is $500. By the way, I'm assuming that there is no debt. So this is a 100% equity company. And the firm B, this company had 10 shares and each is worth $10. So 10 times 10. So the value of B is 100. So again, you can see that there is some acquisition premium. So although the firm B has only the value of 100, firm A tries to give 100 and additional $15. So the additional $15 here is called the acquisition premium. Then the reason that firm A is interested in this merger is because they believe that there is a synergy of $90. So let's see what happens. So let's see, especially in the case of cash acquisition. And then the value of the company is calculated like this. So originally, at the beginning, firm A's value was 500. And there is firm B, which has a value of 100. And there is synergy, which is 90. However, in this case, because we are having a 100% cash acquisition, the shareholders of firm B get 115 and they go out. So therefore, the combined company loses $115. So as a result, the company's value would become $575. And at the same time, now the B's shares are eliminated and only the A's shares are surviving. So we have only 25 shares, which is the original shares of firm A. So therefore, for this merged company, the stock price should be 575 divided by 25. So it is $23 per share. And you can see that this was a good transaction for the firm A's shareholders because they had only $500 in the beginning, but now they have 575. So where does 75 comes? This is the synergy 90 minus the acquisition premium 15. So 90 minus 15 is 75. So this belongs to the acquiring company's shareholders. And let's compare this case with the new case, the stock acquisition. So here, without asking why, let's just assume that there will be an exchange of the shares with 0.5 ratio. So I'm going to give this number first. So there is some reason why 0.5 should be. And let's just assume that for each share of firm B, the firm A will issue 0.5 shares and give it to the shareholders. And then how many shares to be issued? Target company, the firm B, has 10 shares. So by multiply by 0.5, we need 5 shares of firm A. So therefore, the company needs to issue 5 additional shares, and they had already 25 shares. So as a result, what they have is 30 shares. And then the value of the merged company here, in this case, is that the independent value of firm A, which is 500, the independent value of 100, which is firm B, and the synergy, 90. However, we don't subtract 115.5 here because the shareholders of firm B do not receive cash. So there is no cash outflows. They only get the shares. So actually there is no fundamental changes. So we don't subtract 115 in this case. So therefore, it seems that if you add these 3 numbers, it says that the value of this merged company becomes 690, which is better than the previous case. So when we have a cash acquisition, the value became 575. However, when we have a stock acquisition, the value of the company becomes 690. So it seems like it is better, but it's just a seemingly action. So this is a seemingly higher, but fundamentally there is no difference. So let me show you. So to calculate the stock price, we need to divide this 690 with respect to the new number of shares. So we have an increase in the shares. So the new number of shares is 30. So if we divide 690 with respect to 30 number of shares, we get $23 per share, which is exactly the same as the stock price in the case of cash acquisition. So from a shareholder's point of view, there is no difference. And also, if you aggregate and if you compare what the shareholders of firm A and the firm B get, it becomes much more clear. So the firm B's shareholders, what they get is they have 5 shares of the combined company and the stock price is 23. So what they have in their hand is 115, which is again the same as in the case of cash acquisitions. So this is same as what they get, 115 in cash. And second, the firm A's shareholders have 25 shares and each is priced at $23. So if you multiply 23 and 25, you get 575, which is again the same as the value of the firm A's shareholders in case of the cash acquisitions. So we see that whatever you do, whatever you make a transactions in the form of cash or in the form of shares, nothing changes. You are giving exactly the same amount of wealth to the target company's shareholders. However, one thing is different, that now in the combined firm, the shareholders of firm A and the shareholders of firm B, they are living together. So they are constituting the owners of the firm. So the original firm A's shareholders had 25 shares, but now the total number of shares is 30. So what they have is 83% ownership. It means, on the other hand, the new shareholders, firm B's shareholders, are having about 17% ownership in the combined firm. So this is the only difference that we can find from these two examples. Then how can we calculate the exchange ratio of 0.5? So the reason that we have the identical results is because I gave you this number, 0.5 shares. So let me explain how can you get this number. So first, you need to calculate the portion of the payment or the compensation to the target company's shareholders among the value of the merged company. So in this example, the total value is 690 and you are trying to give out 115. So if you calculate this, you get 1/6, which is about 17%. And then in the stock acquisitions, the rate that you can transfer your wealth is that giving them the shares. So the ratio should be the same as the portion of the new shares. So here you have new shares and you need to divide with the total number of shares. However, you should understand that the number of shares is changing. So you had existing shares, but at the same time now you issued new shares. So you should calculate this ratio. And so what I do is to say that the number of shares to be issued is a unknown value n, and I'm going to calculate n/25 plus n. So 25 is the number of shares before the acquisition, and I need to issue new n shares, and this should be the same as the previous ratio, which is 115/690. So you can solve this equation simply because if you multiply 690 to here and if you multiply 25 plus n to here, what you have is 690 times n should be 115 times 25 plus n. So we have 690 times n equals 115 times n plus 115 times 25. So if you move this term to the left, we have 690 minus 115 times n equals 115 times to multiply by 25. So n should be this one, and if you calculate this, you get 5. So after you get the number of shares to be issued, the final step is to calculate the exchange ratio. You are giving your company's shares and you are getting the target company's share. The target company had 10 shares. So therefore, by giving 5 shares, you are getting 10 shares. So the ratio is 5 to 10 or 0.5 to 1. So that's how I get 0.5 in the example. So you don't have to remember any formula. Actually, trying to memorize some formulas make it more harder to understand what is happening. So instead of memorizing the formula in the textbook, I recommend you to follow these 3 steps to calculate the exchange ratio, and it will be much more easier. Okay, So the typical the process is that if the acquiring company intends to have a stock acquisition, what they do is that they assume that they are going to have a cash acquisition, and they negotiate with the target company's shareholders, and they decide in total how much compensation they need, and they apply it to calculate the exchange ratio, and they give them in the value of the stock. So through this process, they can make a deal in the stock acquisitions. So they start from the acquisition in the form of the cash, and if they are needed, then they can transfer it. They can transform it into the stock acquisition. And this is done in the process of the negotiation. And the negotiation, the situation that there is negotiation means the target companies and the acquiring companies they had an agreement that we need to have an M&A. Sometimes, but in reality, they do not have such an agreement. They agree not to agree. So we should start to think about that kind of situation where the target companies do not want to be acquired. So that's about the takeover tactics. I looked into the statistics, and I found that many takeovers or the M&As are friendly ones. By the term friendly takeover, it means that the target company's managers and the target company's board of directors, they are at least trying to negotiate. So they are agreeing that they are going to accept the M&As, but they are not satisfied with the specific terms. So they are trying to getting higher prices. So that's the friendly takeovers. But on the other hand, there are hostile takeovers. So these takeovers are hostile because this is the situations where the target company's managers and the board of directors do not want to have such mergers. So they are opposing it. And this is obviously possible if you think that you are the manager of the target companies. So as emphasized several times, M&As are actually helpful for the shareholders of the both firms. So from the point of view of shareholders, there is no reason to oppose such M&As. However, if you are the managers or the board of directors, there are some reasons to try to avoid such mergers. Remember that one of the sources that the synergy comes is the replacement of the managers. So if you are the manager of the target company, after the merger, you are losing your job. So you are going to be kicked out of your own company. So this is a serious concern because they are also human beings. So you have strong reasons to oppose such hostile takeovers. And then let's see some real world statistics. So during 2015 to 2019, so these 5 years, during the 5 years recently, there were about more than 30,000 acquisitions. So still, at this moment, there are mergers and acquisitions going on. So acquisitions and mergers, they are very frequent ones. But among these numbers, only about 100 cases are hostiles, and the rest, they are friendly ones. So they are smoothly negotiating with each other. But only about 130 cases, they are fighting each other. So why friendly takeovers are more frequent? First reason is because maybe at the beginning, the target companies do not want to have such deals, but as time goes on, after listening to the acquirers' opinions and arguments, they are convinced or they are threatened or whatever they do, they agreed to have friendly mergers. So they were hostile, but at the end they were transformed into friendly ones. And second, maybe if managers and board of the directors are going to oppose the idea of being acquired from the beginning, then there would be no such deal. So many hostile takeovers are not recorded because there were no transactions, right? So they are not included in the sample because at the end they had no deal because they failed to make an agreement, right? So that would be the reason why the number of hostiles takeovers are so small. And finally, this one is a kind of some optimistic point of view. So since 2000, there was a development in the academia, and now we are teaching corporate finance, we are teaching mergers and acquisitions, and we are having undergraduate students in business and administration. We also have MBA students, and we also have executive courses. So as a result, many managers are now doing well. So there is no reason to kick them out from their businesses because they are already doing good, because they are well educated. So that may explain why recently there are no many hostile takeovers.